In May of 2014, the FASB and ISB issued their joint standard on revenue recognition, and it has impacts on almost every industry, but there are particular industries that are going to be impacted very significantly, including those that have industry-specific GAAP today. And this podcast focuses on the changes to software companies. My name is Brian Schilb, and with me is Narayanan Balakrishnan, who is a partner on rotation in KPMG's Department of Professional Practice. The core principle of the new standard is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. The standard puts forth a 5-step model for implementing that core principle. First, an entity must identify the contracts with the customer, then identify the performance obligations in the contract, determine the transaction price, allocate that transaction price to the performance obligations, and recognize revenue when or as a performance obligation is satisfied.
Brian, as you mentioned earlier, this new standard has eliminated industry-specific guidance, which was extensive in the area of software revenue recognition. In that sense, practice is going to change. The new standard would first require an entity to assess whether license qualifies as a distinct performance obligation. That assessment is likely to be different from the current manner of assessment based on whether the services or other performance obligations are essential to the features and functionality of the delivered license. The concept of distinct performance obligation is noteworthy. The second area is, after being able to conclude that the license is a distinct performance obligation, the next area of focus is to assess the nature of the license. The license could be providing access to the intellectual property, or the license could be conferring a right to use the intellectual property. Where a license provides access, those will be treated as overtime performance obligations. And where those licenses confer a right, those will be accounted as point-in-time performance obligations under the new standard.
So why is it important for a software vendor to assess whether or not a software license provides access or a right to use intellectual property?
Brian, as I mentioned, where a software license provides access, it will qualify as an overtime performance obligation. Where a software license provides a right, it will be a point-in-time performance obligation, effectively meaning revenue recognition could be immediate upon the delivery of the license in a software transaction.
Under the current guidance, the arrangement fee is not presumed to be fixed or determinable, where a significant portion of the licensing fee is not due until after expiration of the license or more than 12 months after delivery. In these situations, revenues are recognized as and when the arrangement fee becomes due and payable. Would the accounting for transactions involving extended payment terms be different under the new standard?
Under the new standard, extended payment terms may not preclude upfront revenue recognition. However, if those extended payment terms constitute a significant financing element, they will require adjustments for the time value of money. Vendors would also be required to consider any risk of future concession and also evaluate whether the transaction price is variable and therefore subject to a constraint.
Under existing U.S. GAAP, for multiple element arrangements involving software, entities are required to have vendor-specific objective evidence, or VSOE, of the selling price of the undelivered items to separate them from the delivered items. Would that requirement change under the new standard?
As the new standard has done away with the industry-specific guidance, vendor-specific objective evidence of fair value need not be established for undelivered elements under the new standard. Revenue recognition will follow the general principles of the standard. When the license is viewed as a separate performance obligation, the new standard will require the transaction price to be allocated to each separate performance obligation based on the estimates of the standalone selling prices. Unlike the current standard, entities will no longer be required to have vendor-specific objective evidence of selling price of the undelivered element to separate them from the delivered licenses. This could, in many cases, accelerate software license revenue recognition under the new standard.
PCS typically includes the right to receive telephone support and unspecified future upgrades and enhancements. Given that the new standard is focused on whether or not the underlying goods and services are distinct and therefore give rise to performance obligations, a question is, would the PCS be distinct from the software license and be considered a separate performance obligation, or would you bundle the two together and consider them to be a single performance obligation?
Brian, that is actually a very good question. We don't have a very clear answer, but under current US GAAP, clearly PCS is viewed as a single element. The new standard includes some discussion where PCS is bifurcated into two separate performance obligations. One, the promise to provide telephone support, and two, the promise to provide future upgrades and enhancements on an if and when basis. So it is unclear whether the current practice of straight line revenue recognition for PCS will be appropriate for each of these separate performance obligations.
The new standard will be effective for public business entities and certain not-for-profits in annual periods beginning after December 15th, 2016 and interim periods within those years. So for a calendar year public company, 1/1/2017, and for all other entities, a one-year deferral is allowed. An entity has some choices with respect to transition. First of all, an entity could elect to adopt the standard retrospectively, and if they elect to adopt retrospectively, there are some practical expedients that would allow them to do that somewhat easier. Or an entity could elect to apply the standard using the cumulative effect at the date of adoption approach, in which case they would adopt the standard on 1/1/17. They would not restate 2015 or 2016, but for those contracts that are outstanding and not closed as of 1/1/17, the standard would be applied retrospectively to those contracts. Thank you to Narayanan, and thank you to the listeners of this podcast. For additional information, refer to KPMG's Financial Reporting Network, including the latest on the revenue recognition page, which links to KPMG analysis of the new standard, including defining issues, webcasts, and other podcasts.